Markets are flat this morning as everybody anxiously awaits the Jerome Powell speech today. Here's what you need to know before the bell. Last week, after Jerome Powell gave his presser, of course, markets took off on the idea that he said that, well, monetary conditions in the short term really don't matter. That kind of gave markets the green light to kind of run up a bit more, saying, well, if he doesn't care about short-term conditions, we're going to keep moving prices higher. This morning, futures are basically muted ahead of a speech that Jerome Powell will give today. Everybody is wondering, will he try to walk back that statement a bit, given the recent run in the market following his last speech? While he may say that he doesn't care about monetary conditions in the short term, they matter, and they matter a lot, and particularly in this case where monetary conditions improving or becoming easier allows investors to go out and consumers and businesses to operate more functionally in the economy. That's going to lead to better economic data. Of course, stronger economic growth is going to lead to a potential resurgence in inflation. And this comes on back of this recent report from unemployment that showed unemployment dropping to near record lows, the lowest level since 1969. And of course, wages remain a top issue for businesses because of the increase there. This all has to give concerns to the Fed about a potential rise in inflation at a time that they're trying to still get that down. So again, markets are a little bit muted this morning, but after a big run up here over the last few days, again, we got into 3 standard deviation territory above the 50-day moving average. This correction of the last couple of days, not surprising at all. Again, it's been very mild. Actually, markets are closing up from where they opened. We've got green candles over the last couple of days. That's a fairly bullish correction at this point. But again, we'll see what Jerome Powell says today, because that could be a big driver for both the stock market and the bond market here over the next few days. Speaking of bonds, I'm getting a lot of emails as well asking, is it time to buy the 10-year Treasury now that we're getting closer to that potential recessionary tick in the economy? Not just yet. We had a decent run in bonds here over the course of the last few weeks. Both the stock market and the bond market remain fairly well correlated. The recent correction in the stock market has also led to a correction in the bond market. We are on a short-term sell signal for bonds. So again, not exactly the right moment here to be adding to longer duration bonds in your portfolio, but I think you'll get that opportunity here over the course of the next couple of weeks. And again, some of this will depend on what Jerome Powell says today. This discussion of potentially higher rates could press bond prices lower here short term. But again, markets are sitting right here on the 50-day moving average for bonds right now. We'll keep a watch on that support level. A break of that level will likely bring TLT down to about 105, and that may be a much better entry point right around that range for adding bonds to your portfolio. If we still have a recession later on this year, yields will fall, and particularly when the Fed starts cutting rates sometime next year, that's going to lead to lower bond yields and higher bond prices. So again, just looking for the right opportunity to increase that duration, but today's probably not it. Give it a little bit more time to work out here. The big point to watch here is what Jerome Powell says today, because that will potentially change the dynamics for both stocks and bonds over the course of the week. I'm Lance Roberts, and that's what you need to know before the bell.